Why am I concerned with cost budgeting?
Cost budgeting, or setting the cost baseline for a project, is very important since it forms the foundation for the measurement of performance in the project. Ultimately, our performance measurement system is going to measure the actual costs of the project in terms of time and quantity and compare that to the planned expenditures in terms of time and quantity. Any error we have in the amount of budget set aside for a particular activity in our project or the timing of that expenditure will result in over or understating the performance of that part of the project team. If one of the tasks in the project is budgeted for $2,000 when it should have been budgeted for $1,500, the performance on this over-budgeted task will be unjustifiably high. Worse, the actual cost of the task could actually be $2,000 because work tends to fill the time allowed and spend the amount for which it was budgeted. Most managers will not take corrective action when tasks are being done within their predicted budget. Setting of budgets also has an effect on the business itself. All companies have financial managers who must concern themselves with the timing of the expenditures of the company and making sure that there are funds available to pay the bills. Budgeting too much for a project means that excessive funds that are not required will be on hand. Not budgeting enough for the project means that funds will have to be found for the project on short notice. Tell me more. Placement of the budget in terms of the amount of money that will be spent on the individual tasks of the project as well as the timing of those expenditures is necessary for any performance measurement system to work. It is also important in helping the company manage its cash reserves so that enough, but not too much, money is available when it is required to pay bills that become due. Any performance measurement system will be a measure of the comparison of the expected result to the actual result. In the case of projects, we are usually interested in the measurement of performance in terms of the amount of money that is being spent and the time in which it is spent. The earned value reporting system is excellent for measuring project performance but requires careful placement of the project plan in terms of quantity and timing of the planned expenditures. If the planned expenditures are not in close synchronization with the actual expenditures in terms of quantity and timing, the project will indicate a level of performance that is higher or lower than is actually the case. Suppose we have a project with a sizable amount of internal labor being used to complete many of the project tasks. We plan the expenditures for this work according to the project schedule. The project schedule shows when the work is taking place. Each person working on project tasks reports the work by task worked on and by the number of hours spent on each task. We will assume that we are doing this on a weekly basis. So, for example, Sarah Lee works on 4 different tasks during the week. She works 20 hours on task 1, 10 hours on task 2, 4 hours on task 3, and 6 hours on task 4. The time card she reports this on is sent into the payroll system in the accounting department and processed through the computer system. Corrections are made in the payroll system, and a report comes to the project manager 1 week later. At that point the time is shown as actual cost, but it is a week later than the time when the work was actually done. In addition, if the project manager finds a mistake on the report, it will take another week for the report to be corrected. Figure 4.1 shows the overall effect of timing on cash flows. The timing of planned and actual cash flows must be the same or project status and performance reports can be misleading. Figure 4.1, Commitments and actual cash flow. This problem can become worse if there have been errors in reporting from other projects or functional areas. What we mean by this is that one department or project team accidentally charges time to one of your project tasks. If you catch it at all, it is in a report that you see 1 week later. If you find the error and make the correction, it will be another week before the report shows it correctly. If the change requires approval of the person who made the mistake in the first place, it may take another week for the change to be made. All this makes the timing late for the actual cost to be recognized. Meanwhile, the work has been done, and the completed work has been credited to the project, but the actual cost is less than it should be, and the performance is unjustifiably high for that task. Material cost is a problem as well. Frequently, the task of ordering material for a project is considered complete when the project team has finished the work. Figure 4.2 shows that there is quite a lot of time involved between the time when the project team finishes the work of writing the requisition for materials for the project and the time when the actual cost of the expenditure is recognized. It is most convenient for the project team to recognize the completion of the work when the work of the project team is complete, but it is more accurate if the cost is recognized at the time the invoice is paid. In terms of the timing of the completion of the task, it is better to show the task as being completed when the person doing the work has completed the work,